etc. What do we have? First trades. The pre-open was indicating a 50-point higher start, and we're getting about an 80-point uptick as far as market open is concerned. 25,200 nearly. You've got the Nifty Bank, which is up 0.25%. That's 51,920. This is a pretty good start. Sensex is up about 1/3%. Mid-cap index is up 1/3. IT index is up 0.6%. We'll look at HCLTech stock as well in just a bit. The Nifty heat map is coming up on your screen, and it's largely up in the green. So yeah, I mean, about 8 odd names which are lower, but everything else is starting in the green at this point in time. Let's get to stocks a bit.
Okay, well, Reliance for the time being has started off a little on the weak footing, about 0.5% lower. There's ONGC, which is also down. So there's a very clear crude play with the upstream guys losing out. And if you look at BPCL, it's the top Nifty winner. So the marketing and refining companies are having a much better day. And I'm looking at the others as well. Along with BPCL, IOC and HPCL, all of these stocks up between 1 and 2%. So that's your crude play immediately. Asian Paints, again, explains what's going on. I mean, 1.5% up. So sentiment up move in a lot of the beneficiaries with the crude oil prices falling overnight. Infosys is up about 0.7%. Let's see what HCLTech is doing, because the performance was really good. About 0.5% up on HCLTech, with the guidance increase coming in at the lower end. Trent, SBI Live, Britannia, these are some of the other stocks that are contributing this morning on the upside. The market's cooling off just a little bit, about 60 points higher. Reliance is now the big drag on the way down, 1% lower. I think the retail performance is something that wouldn't go down too well with the street, just because it's a little sluggish at the top line level, while Jio is firing on all cylinders. JSW Steel, Hindalco, Coal India. So these are the other stocks on the losing side. So oil and gas, commodities, metals in general, a little soft as we start the day.
Well, I think the stronger dollar is playing its role, right? There's an inverse relation between metals as well as the dollar move. So I think the stronger dollar overnight is plaguing some of those metal-related names. Let's focus on a few names. Angel One, splendid results, stock firing away, up close to around 7%. So good move is what we're seeing out there. Oil cools, as should be mentioned, you have OMCs that are doing well. And Berger Paints, that's one of the big gainers today. That's up close to around 3%. So that's doing very, very well in today's trading session. India Mart as well is up close to around 2%. So good move is what we're seeing out there. Ola Electric, I think I saw a shade of green to kickstart trade. They kickstarted the festive season on a strong note, is what they've said. They've cemented their market leadership further in the EV two-wheeler space. And as of October 14th, they say that their market share is at around 34%. So the street likes that. For the time being, that's opened up with some green. Last few days, we've seen good amount of volumes on Greaves Cotton as well. That stock as well has opened up with a gain, I think, of around 2%. So good move is what we're seeing on that one. Bartek Vabag, they won a mega order of around 1,000 crores odd towards a seawater desalination plant at Indosol Solar Project in Andhra Pradesh. For the time being, that one as well, I think, has opened up higher. Bartek Vabag, let's pull up that stock. The order book now, I believe, is close to around 15,000 crores, which is super duper. So good order visibility, up 2.5%. Jain Irrigation on the losing end, that's one of the volume losers. It's down to around 62 rupees. It was around 85 rupees earlier this year. So that's seen a sharp correction. One of the stocks that bounced back and now getting sold into. So 62 rupees on Jain Irrigation as well. But otherwise, a good start.
It's a good start. 65 points. So 25,000, just under 25,200 is where we are at. The biggest volume-led gainer is Angel One with an 8% pop. So that is right there on the leaderboard. CDSL is another one, which is a close second, 3% higher and very large volume. CDSL was, of course, a big mover yesterday as well, along with BSC, which went up 7%. Let's look at BSC for a quick bit as well. Big volumes, by the way, on BSC yesterday. 0.5% on, so 48.32 there. Actually, it's all capital market plays, right? JM Financial is the number 3 biggest volume-led gainer, 5% pop, 163 on JM Financial. I can spot CAMS with a 1.5% gain. So that is at number 6 or so, but big volumes on that one for this point in the day. 361 is another capital market play, 2%. Wealth Manager, 1,085 there. But volumes here are a little lower. K FinTech, decent sized volumes. K FinTech is up about 2.5. So I think a lot of these capital market plays are doing well. What else? RK Forging is up 2. I mean, HPCL is up about 3%. We should look at IOC and BP as well. With the drop in oil, that's tends to have a reaction. Premier Explosives saw a big move yesterday, and I think it's up another 7% today. So from Thursday's close of 248, stocks moved to about 320 in 2 sessions flat. So that's something to watch out for. VATech Vabag, I was talking about this. The order this morning, 7% yesterday, another 3.5% this morning. And there's Wockhardt Pharma, which is starting about 5% in the green as well. So 1,098 right now.
On Wockhardt, I just want to mention, ever since they announced them nearing approvals for this pneumonia drug, it's an antibiotic drug for pneumonia, where they're getting approvals in India. The stock's been doing this 5% circuit yesterday and today. So the market's pretty excited about the opportunity. And on RK Forgings, UBS has initiated coverage with a buy call. They think 1,500 is possible on the stock. That's the target price, which is substantially higher. So that stock's in focus. But look at the star today, Angel One, flying away, 8% now.
Absolutely. So let's actually start our conversation with Rahul Arora, who's with us here in our studios on Angel and other capital marketplace. Rahul, of course, is CEO of Nirmal Bang Equities. Rahul, good morning. Good to have you with us here. So before we get to markets and everything else, capital marketplace, right up your alley in that sense. What's the sense, Rahul?
So first of all, morning. Thank you for having me on the show, and very happy festivities to you, your team, and your families. Well, on a lighter note, I declared my results to my board yesterday. So it doesn't surprise me with what's happening. I think the listed guys at least give you pre-quarter disclosures. So I think it's been a remarkable 6 months. Our business is a derivative of the mutual fund industry. The more they do, the more they churn, the better for us. It's literally as simple as that. It's all a question of, the SIP flows, really. I think the fact that they're still continuing 25,000 crores a month, you're still seeing, just look at the amount of demat accounts that were there when you went into the lockdown, compare them to what you have today. I think that number is up, 5x, 6x, something like that. So nothing is surprising here. I think, Prashant, in our business, it's purely operating leverage. So my costs move once a year, which is basically when I give my salary hikes. That's my raw material as a percentage of sales is my raw material is my people. And that's true for any player in capital markets. So any incremental activity in the market basically flows straight through your bottom line. So, while I don't want to get too specific into our numbers, I think we're at a 43% ROCE for 6 months.
Wow.
So, you can just imagine theoretically if I was to list
in
this market, I'd get a reasonable valuation as well. But it doesn't surprise me that, I think you're going to see the same kind of results when Kotak Bank declares. I think you'll see that in Kotak Securities. You'll see that in Motilal Oswal, Edelweiss. Angel's doing remarkably well. I think what they're doing with the digital part of the platform. So CAMS, BSE, NSE, I think in the grey market, you're seeing what's happening to the price of NSE as well. And I think in the unlisted space, it's all going on a whack.
What's happened
Swiggy.
to, have there been any new trend? There are no sellers on the NSE.
No, there are no sellers, and that's why, you are having the price sort of artificially jack itself up. And, somebody was telling me recently the CCPS deals of Swiggy were happening at about 350, and the grey market price is about 550. So, if that's the kind of sentiment you're dealing with, then you just want to hold on to capital marketplace. Now, the question is what valuation you want to buy them at, and then that's a question you can ask for any sector. But at this point in time, if I was a holder in any capital market-related stocks, I don't think I'd be selling them at this point in time. The times are good. Even if you do have a correction in the market, I don't see any reason why, like I said, it's churn at the end of the day. So it's good for business one way or another.
If you're a holder, there's no problem at all in life, like in market in general, right? It's always about people who are trying to sort of, find an entry point into areas where there seems to be good business runway, but then at what price? So therefore, on capital markets, give us that number. What perhaps would be fair value in a sane world?
So, okay, let me put it this way. When HDFC Mutual Fund listed, I think for a 40% ROE, ROC, I think the peak multiple it got was about 48 times, if I'm not mistaken, on a price to earnings. If you go somewhere around 45, 48 times, because these are not very high capex intensive businesses. So you're not going to have inventory, working capital issues. You're not going to have governance related issues. It's a very straight, predictable, simple, seedha sada business. So I think in a good time, you can give it somewhere between 45 to 50 times. I think anything above that may be a little excessive, even if the markets are doing well. And if you get these stocks around 35 times, then it's a great entry point. I think an entry at around 30, 35p and exit around 50, you've more than made your money.
So that's I guess, that's on the broker side, right?
No, that would hold true for asset management. I think even insurance, I think, I think if you look at the last insurance numbers that came out on the private, on the APE side, remarkable. SBI Life was soft, but I think if you look at Max, iPru or HDFC Life, they all grew 25 to 35%. Now, of course, there's a very large ULIP component there, which is also a proxy to capital markets, if you will. Right, it's one of the reasons ICICI Pru Life has always got a slightly lower valuation than the rest, because they've always traditionally had a higher ULIP book, which is sort of, more market linked, and that's why, because they've been a little low on protection or the conventional business, their VNB margins have not been as high as their competitors have. So, of course, that valuation gap has caught up. But even today, I think if you look at it on a price to embedded value, all these guys are trading at about 2.5 times. So I don't think anything is that expensive at this point. I mean, if you go back 3 months and you peg anything to what defense was trading 3 months back, I think the market is still cheap.
Okay.
But I think there's been a reset in those valuation as well. So would I advise fresh buying into capital market plays? I'm not so sure, but if you're holding them, I see no reason to sell.
All right. Hi, Rahul. Good to have you in the studio. Since defense has pulled back a little bit, and that was the big call that you all made as well, but valuation still far away from comfort levels for you all?
Well, some have approached interesting levels. I think if you look at a Hindustan Aeronautics is trading at about 25, 27 times now on FY26 earnings. We're expecting about a 25, 30% kind of compounded earnings growth, like in 25 and 26. 27 is too far out to call. See, the good part, Nigel, is that theoretically, if these guys don't even get a single order for the next 2 years, I think their order backlogs are still so strong. The only issue is, are these orders once executed, are they going to see offtake? Because their biggest client is the government of India. So the point I was making a little earlier about inventory and working capital, there is a bit of risk in these businesses as far as that is concerned. But I think names like BEML, which is also down to about 32, 33 times, could potentially be looked at. Data patterns, again, not a cheap stock. Obviously, it's not a public sector as the first two are. That's come down to about 40 times, I think, somewhere thereabouts from almost, 60 times. So I think some of these where we are comfortable that earnings are going to grow at 25, 30%, we are selectively telling people to sort of come in and buy defense names. But it's not a blanket overweight call. It has to be very stock specific. Okay. Valuations could still reset a little bit, but I think that 25, 30% fall, in some cases even 35, my mind goes back to Mazgaon. When it fell 35%, it had 2 days of 88% rally. So I think that goes back to Prashant's earlier point about capital markets, because there's so much liquidity, good quality stocks, you're not allowing them to fall in a meaningful way. So maybe if you get a good 30-35% correction,
some of these could be interesting.
Yeah, I mean, these three names I gave you, BEML, HAL, and data patterns could certainly be looked at.
All right, let's quickly wind this down with the auto sector. Then we have a new IPO, Hyundai. What's the view out there? Plenty of debate, and we'll get to the management in just a bit. But your view?
Well, 14 pages of an anchor book. I think, that itself tells a story. But no, I think obviously, for people who want to play it, I think the biggest risk remains as to what happens from a flows perspective with respect to Maruti, because this is probably a like-to-like comparison. But I think Maruti has withstood so many things thrown at it. The only thing is I don't see too many launches coming up, Nigel. I think even Maruti has not announced too many launches. Okay. I think if anything in auto right now, we don't even want to play two-wheelers. I think the CV cycle is virtually topped out. Tractors are doing sort of okay. But I think our pecking order would be two-wheelers one. Within two-wheelers, I think Eicher is what we'd like to play in terms of premiumization. You can follow it up with tractors, M&M, and probably passenger vehicles would be third. But our tilt would still be towards Maruti as opposed to Hyundai. Like I was telling Prashant earlier, valuations in the unlisted space have gone berserk. You've seen what's happening with Swiggy and NSE. So let's see the performance of Hyundai once they live. They've done a remarkable job in India. There's no question with their product portfolio. But we'd still probably prefer a Maruti. But within autos, two-wheelers would be the preference.
Rahul, we promised to get you back, and you must come back, because I was looking forward to a full-blown consumer discussion. There's so much going on with what DMart is saying with quick commerce, what Dabur is saying.
Reliance Retail as well.
Reliance Retail. There's so much to talk about. It will call for at least another 10-15 minutes of conversation. So we'll have you back sooner rather than later. But thank you very much for this morning.
Thank you for having me.
Okay, with that, let's quickly move on and look at the next set of major earnings that came in, of course. Yesterday, HCLTech reported a strong second quarter. Revenue beat estimates and the margin expanded 150 basis points on a sequential basis. The company also raised the lower end of its full-year guidance from 3 to 3.5%. My colleague Rima caught up with C. Vijay Kumar, CEO and Managing Director, as well as Shriv Walia, Chief Financial Officer of the company, and began by asking where the margin beat, where the beat came from this quarter, and which verticals and geographies have been performing the best. Take a look.
So overall, across the board, we found the growth picking up in the last quarter. So financial services definitely had a strong performance, adjusted for the divestment that we had. And across the board, whether it is retail CPG or tech and services, life sciences and healthcare, these were the top three verticals in addition to financial services, where we saw incremental revenue, which helped us do better than our own expectations.
CVK, you're still cautious about extrapolating the strong Q2 demand. Why is that?
Yes, I think today we just need to be a little cautious because the demand has been very volatile. Like in calendar year 2022, November, December is when we got signals of serious weakness in the spend environment for the clients. And of course, we are remaining cognizant of the broader macro and geopolitical environment and being cautious that we don't want to extrapolate it. Obviously, we've done well. That's why we've increased the lower end of the guidance. And we need to give it some more time before taking a strong view on the overall demand environment.
But do you think the environment currently we're in is similar to November and December of 2022, which is when demand weakness crept in? Are you seeing any likeness in the environment?
No, the demand environment is significantly better than what we saw in the last quarter. But the reason that we are not extrapolating this to the future is based on the experience that we and everybody in the industry saw in 2022.
Okay. Shiv, I believe you've called out the impact of the wage hikes, the impact of the wage hikes on margins for Q3 and Q4. So can you tell us that? So with that, do you think you're likely to end closer to the lower end or the upper end of your margin guidance of 18 to 19%?
So yes, we have called out the wage hike impact is going to be 60 to 85 basis point in Q3, and maybe another 50 to 60 basis point in Q4. But Riva, in terms of, I don't think it's going to make any impact. It's part of the planned wage revision we have done, and our margin guidance are still intact, 18 to 19% quarter on quarter, year on year. I think we are confident of achieving that. But I would not like to call out low end or high end because this is a planned wage revision we have done for this year.
CVK, what's the outlook? Some more color on BFSI because BFSI X of the divestment grew 4% on a quarter-on-quarter basis. And green shoots in BFSI is something that we've heard from across IT players. Are you at least confident about BFSI demand sustaining going forward? What's the momentum like?
I think BFSI North America picking up is something we had called out in August itself. And now I would say that the demand is a little more broad-based in the financial services. We found very strong growth coming in from Asia Pac, which is our growth markets. Europe as well grew quite well in the last quarter. And in the US, especially insurance, definitely grew well. So I think it's a little more broad-based and we feel good. And it's really what's happening is there's a lot of modernization programs where clients were a little cautious, but with Gen AI also giving a lot of promise on what can be done in modernization, we see some of those programs really taking off.
And what's the outlook on the other sectors? Are there any spots any verticals where you're still a bit cautious?
I mean, it's really micro verticals. Maybe I think auto in some segments, like for example, Europe automotive segment is under some pressure. There are specific clients in aerospace where there is definitely some pressure. But all of this goes into manufacturing. But manufacturing demand is also accentuated by a lot of SAP migrations that you see in the traditional manufacturing companies. So that's definitely offsetting some of the demand softness and some of the challenges that we are seeing in specific clients.
Would you say the discretionary demand is back to some extent?
Sorry, what was that question?
Would you say the discretionary demand is back, to some extent? Earlier, it was all about cost optimization, efficiency.
Yeah, definitely. So this quarter, the growth was fairly balanced. If you look at our ITBS, it's grown about 1.8% sequentially. and adjusting for the divestment, it's probably closer to a 3% growth. What does this mean? I mean, maybe 2.5% growth. And this 2.5 is quite well balanced between efficiency-led programs, which we had won, which are getting ramped up in the last quarter, and incremental demand coming from a lot of existing customers, which are mostly discretionary in nature. They're largely around data, and AI is the biggest theme, and compliance and programs on modernization and things like that. Those are the discretionary aspects which we are seeing pick up now.
Shiv, what's the outlook on hiring? Your net employee base contracted for the second consecutive quarter. And even on attrition, will it stay stable for the next 2 quarters, according to you?
Starting with the first question, on the hiring front, on the contraction of workforce, I think if you see if you take out the divestment-linked State Street divestment, so on the year-on-year basis, our workforce has increased by around 2.4%. And we have, last year we hired around 12,000 freshers, despite the fact that industry hiring was muted. And as we announced in August, we have a Ascent program kicking in now, which we intend to have Gen AI-led productivity and efficiency improvements that will help us to, I guess, gain some more productivity and utilization, as well as I think we are going to have AI-led program to reskill and train our employees. So that will also give us the leverage required to meet the demand. So we have not worked out. We do intend to hire additional maybe 2,000 freshers this year, but that's it. I guess we don't expect for the next year. We have to plan out the fresher hiring, work out the plan on this.
CVK, is it possible to quantify what the AI or Gen AI pipeline is?
I think, I think it's kind of a misnomer to kind of look at Gen AI pipeline, because a lot of pipeline is dependent on what programs Gen AI can enable an enterprise. So, of course, the modernization, there is a lot of modernization programs which are becoming viable, and customers are focused on eliminating technical debt, where they're using Gen AI as a very important tool. So I think that pipeline is quite strong. The second aspect is to get the right leverage out of Gen AI. Data is a very important underlying ingredient. And so a lot of work on streamlining data pipelines, all of that is where we see demand. And the third element is as customers are looking at scaling Gen AI, the underlying infrastructure, whether it is a hyperscaler or private AI stack, both of them are being used in different scenarios. So I think these are the 3 broad elements: modernization, data and AI, and cognitive infrastructure. All the 3 are the manifestations of Gen AI programs.
One final question then. How are the decision-making cycles? Have we seen a pickup? And is it realistic to expect a pickup in budgets next year because of the interest rate cutting cycle in the US, a potential thaw once the US elections are out of the way in decision-making?
Yeah, it's a little early to call that, Rima, but given what we saw in this quarter, and if you want to remain optimistic, I think it should pick up a little bit. But at this point, we have not baked in some of that. We really are focused on executing the current demand that's on hand, and being a little bit cautious about the broader macro environment and some specific client issues. So we'll wait for this quarter before taking a call on the longer term trend.
And do you think you'll end at the lower end or the upper end of the revenue guidance based on the visibility that you have right now?
Right now, it's 3.5% to 5%. That's a range that we've given, and that translates to 0 to 2% on a quarterly run rate. So I think we're comfortable. We're not trying to be more precise than that.
Okay, the demand environment is getting better, but HCLTech remains cautious given the macro setup. We need to take a break on that note, come back on the other side, and then the big interview of the morning. Tarun Garg of Hyundai Motor India will connect with us as the company gears up for its mega 27,800 crore rupee IPO, which opens out for subscription today.
Welcome back. Well, let's turn the spotlight on Hyundai Motor India's 27,000 crore rupee IPO, which is India's largest ever share offering. It opens today for subscription and it will close on October 17. The company has raised close to around 8,300 crore rupees from 225 anchor investors prior to the issue opening. To help us out with a few more details, we're joined by Mr. Tarun Garg, the Chief Operating Officer and Whole-Time Director at Hyundai Motor India. Hi, Mr. Garg. Good morning, and thanks a lot for speaking to us here on CNBC-TV18. Well, before we get to the numbers and other details with regard to the company, personally, I would like to tell you that I have driven a Hyundai, and I'd owned one, and I had absolutely no problem with it. The i20 is the one that I'm talking about. It was very good. Service was top class, and happy to have experienced that. But now we need to talk about the markets because you're going to be listing on the Indian bourses. So welcome to the Indian bourses in a few days from now. Couple of details is what I want to get out of the way. One is the royalty increased ahead of this IPO. So the markets want to know whether or not this royalty rate that you're fixed as of now, it holds for the next few years. If yes, when does it come for renewal? Point number one on royalty. And the second factor is there was a big dividend that was paid out to the parent ahead of the IPO, which was a very, very large one. How do things shape up from here on the dividend policy as well? Royalty and dividend. Please go ahead, sir.
Thank you so much. And regarding royalty, as you know, the royalty rate is 3.5%, and we believe that it is going to be there for a long time. Regarding the effect of royalty on the results, if you can see our financial year 25 quarter 1 result, which is including of the new royalty rate, and you have seen that we have managed to have a EBITDA of 13.5%. So that is one. Regarding the dividend, frankly speaking, we had not paid dividend to the parent during the COVID year. So this was also a kind of an accumulated dividend. And just to bring in transparency in the whole process and to make the IPO process smooth, we decided to kind of pay the dividend before the IPO process set in. So I think on both counts, this is where we stand. And going forward, of course, once the financial year 25 is over, we'll decide based on the earnings, based on our capex requirements. We'll announce the new dividend policy, and of course, we'll keep in view the best practices in the industry while deciding the dividend policy.
Yeah, the dividend was interesting because you paid out, a very, very large sum, which is much higher than the cumulative for all the previous years. But we get your point. We'll wait by for the dividend policy. This royalty of 3.5%, when does it come up for renewal?
So it's going to be there for a long time, the same royalty, and we don't think that there is any reason for royalty to go up in the near future unless something very, very different happens in terms of OECD guidelines or transfer pricing issue. We expect the royalty to remain at this level for a long time.
Okay, Mr. Garg, got it. So that's the royalty issue sort of settled for now. And great to have you with us on the conversation, sir. We want to take up something that always comes to people's mind, whether they're your customers, I'm sure, potential shareholders as well, which is the big fight in the SUV space, right? And we've seen the numbers. We were speaking to the Industry Association just the other day, FADA, and it's very clear that while car sales continue to be weak, it is the SUV segment that's keeping the overall passenger vehicle segment intact, right? Now, here, there is a lot of sort of fight between yourselves as Mahindra, and obviously Kia has emerged as a major competitor in the last couple of months. And, the parent owns 34-35% in Kia Motors. So the street wonders whether there's any conflict of interest. What about cannibalization? I mean, Venue is doing well, but then so are all the Kia models. What is your market share right now in SUVs compared to Kia? And how do you resolve this potential conflict of interest and cannibalization between the two companies where the parent already has a significant stake in Kia Motors?
So look, if you see our history in India for the past 26 years, HMI has always been ahead of the curve in terms of identifying trends. In fact, in 2015, when we launched the Creta, SUVs used to contribute only 13% to the overall market. And of course, things changed dramatically. Today, in the TIV, SUVs are contributing 52%. As far as Hyundai is concerned, we have a big range of SUVs. And January to September period, SUV percentage is at 67%, much higher than the industry. In fact, in the month of September, we touched 70%. And what is exactly happening is actually our rural markets are also contributing the same to the SUVs. The rural penetration also stands at 67%. I think this is a very clear indication how the aspirations in the rural markets have also caught up. As regards competition, look, competition has always been there in India, whether it is from Kia or anybody else. But if you see Hyundai's track record and you see our models, Creta, continues to show a double-digit growth. In fact, we are selling close to 15,000 units consistently every month. Of course, this double-digit growth in Creta this year is coming on a back of last year, which again had a double-digit growth. So absolutely, you can see that because of our strong lineage in India, because of our strong product pipeline, because of our strong brand connect, because of 8.5 million customers who have really given us love and affection in India all these years, we believe that we have all the wherewithal to tackle all kind of competition like we have done in the past.
So just to clarify the number, you said in September, 70% of your total sales are SUV, right?
Absolutely.
Yeah.
70% of our total sales for SUVs in September.
In September, got that, sir. I'm just trying to understand how the market share is moving and where Hyundai is vis-a-vis, say, a Mahindra and Mahindra right now or a Kia. What is the gap? Just to understand how the pecking order is placed at the moment, if you talk about total SUV sales.
So of course, in terms of market share, our SUV market share January to September stands at 17.9%, and it is we have not lost any market share versus last year. Our last year market share was also 17.9%. You have seen that we introduced the Exter last year, which received a very good response. This was a new segment which we were entering into. This year, we apart from the Creta, we have launched the Alcazar facelift, which has received some great response. Also, we have introduced dual CNG cylinder in Exter and Nios, which is again getting us some great traction and great volumes as well. So I believe that Creta is today now the third biggest brand in the Indian auto industry across categories. And of course, the segment leader in the mid SUV segment. So you can see that the volumes continue to grow and the market share continues to be stable. And our average selling price, because of this high SUV contribution, continues to go up, affecting our margins also positively.
Mr. Garg, hi, good morning. Prashant here. What is the, now of course, people would want to know what is the future plans, right, in terms of management aggression to grow this market share in the SUV segment especially, which you say has remained pretty steady. Overall market share, though, if I look at, say, 2020, FY20 to today, has come off. It stands just under about 15% or so, the share of the market. Would you want to grow in line with what the market grows? Would you want to significantly outgrow that market? I mean, what is the level of aggression that you will bring to the marketplace?
Absolutely. In fact, if you see, our current capacity is 824,000. Next year, our Pune plant kicks in with a phase 1 of capacity addition of 170,000, which will take us to 994,000. And of course, then 80,000 more in 2028, which will take us to almost 1.1 million capacity, which is a 30% addition in capacity. So we are geared up in terms of capacity to take care of both our domestic as well as export volumes. Also, if you see, the EV space is where probably we have a lot of headroom to grow. You would have seen in our RHP that we are going to launch the Creta EV in financial year 25 Q4, which is absolutely basically next quarter itself. Creta is a very strong brand. We believe this could be a very big game changer. And then going forward, 3 more EVs in the mass and premium segments will be introduced. And not only that, we are lining up these EVs along with a very strong localization plan. So as we speak, the battery packs are being localized. We have already announced a collaboration with the local Indian partner for the LFP cell manufacturing. We are looking at power electronics, drivetrain as well. So the entire EV ecosystem is being localized. Also, we are investing in the charging infrastructure as well. So you can see that will again add to the market share along with the increase in capacities. Of course, we have a very strong product pipeline. As we have done in the past, we always look at what are the gaps available and what can we do to really fill those gaps and increase our volumes as well as market share. The second thing I like to say is that we believe in quality of growth. So volume, market share and profit. So you can see, if you see especially in the last 3 to 4 years, how our ASPs have grown, how our EBITDA margins have grown, how our return on capital employed has grown. I think that is also very important, and that is also an integral part of our strategy. The third point is, if you see our capacity utilization, it has consistently been more than 90% plus. And I think this is again one reason of our very stable and increasing returns, because we have a very good mix of 80% domestic and 20% exports, which gives us not only very precious foreign exchange, but also a dollar hedge, and also to take care of some kind of fluctuations which happen in the market. So I think this balanced approach with a big focus on SUVs, always looking for some opportunities, and of course, volume, market share and profit in tandem going together. I think this is the approach we have taken, and this is the approach we wish to take in the future as well.
If you can put it in, and that's very well explained, Mr. Garg, but internally, what is the message? You have, is the message or the aim to grow a few percentage points above the industry growth? Is it to grow in line with industry growth? Just to get a sense of what the thinking is. What's the messaging?
No, look, I'm a sales guy. Absolutely, every sales guy will want to improve our market share, and we will surely want to improve our market share. And what I'm trying to tell you is that now the resources are also there.
Okay. But
in terms of capacity, in terms of electrification, in terms of a pipeline, product pipeline, so everything is going for us.
No, sir, if I could come in over there and add to what Prashant is trying to, I think, get at, is that in general, there is a concern, despite all the the SUV boom that we've discussed. In general, if you look at the category, auto sales, in the PV segment, they've slowed down to mid-single digits, right? If you look at June numbers, Hyundai's June numbers, you're at around 5% growth in terms of revenue. So, I mean, what can one expect? Is that going to get better, or is this the new normal, so to speak, post-COVID, which is probably not a very hot number that the market is looking at, and probably the market would want more? So, at an industry level, what would be the revenue growth estimate, and how much more, higher than an industry, can you do?
Look, this is very important, and if you see, I have spent now more than 3 decades in the Indian auto industry. If you see CAGR, 5-year or 10-year CAGR, it is at 5%. Of course, post-COVID, because of the pent-up demand, in 22 we grew by more than 22%. Then we grew by more than 8 to 9%. So some kind of moderation had to happen. I don't think anybody should be surprised with that. The other thing is, if you're talking about June, July, August, September periods, because of heat waves and because of floods, etc., these are normally slow months. October, I think after a long time, both the festivals, Navratra, Dashera, as well as Dhanteras is in the same festival. As far as HMI is concerned, we are seeing a 29% increase in Vahan registrations in the first 2 weeks over last month. So already we are seeing very positive offshoots. The festival has started on a bang. So I don't think we should be really worried by 2-3 months of a moderate growth or degrowth.
But you're saying 5%,
this has happened so many times in the past.
But sir, what you said, that's a big statement, right? And that's very important context. You're saying that if you go back to pre-COVID, then on a 5-year basis or even a 10-year basis, the steady state growth rate has been 5%. So are we back to that? I mean, was that the original normal and we are back there and we should be satisfied with 5% growth?
Look, what I am saying is the CAGR has been 5% on a 5-year or a 10-year period. CRISIL has said that the next 5-year CAGR could be in the range of 4.5% to 6%. I think this is what the data is saying. Okay. And I think this is not bad, you know. Sometimes we feel that probably 20% is a norm. Please understand, this year also we are growing on a very high base. In fact, as an industry, in 22 itself, we had reached the pre-COVID levels, whereas many countries in the world were still struggling to reach that level. So I think we have to see the base effect as well.
Okay, all right, Mr. Garland, let's focus on...
The second important point, I think, which...
Yeah, go ahead, sir. Please complete that point.
Sorry, but the second important point here is the premiumization, you know, because one is the volumes, the second is the average selling price, and the premiumization which is happening, the SUV percentage which continues to go up, the higher trims which are being sold. I think that aspect also has to be taken into account, because this is the new Bharat we are talking about, where aspiration has taken over functionality, and people are wanting to take higher trims, they want connected cars, they want sunroofs. So average selling price is going up. So the revenues are growing at a much faster rate than the volumes. I think that is also a very important aspect which we must keep in mind.
All right, the premiumization play as well. You know, Mr. Garg, you briefly mentioned on a couple of aspects. Exports. Exports are in early 20s, I understand, as a percentage of your total mix. And exports, I presume they're better margin business. So that's what will help your margins as well. Give us two numbers. What does export stabilize at as a percentage of the mix? And also I was looking at, you know, raw material imports. I think that as well is in early 20%. What is the plan on that front? Do you look at reducing that dependency?
Yeah. So if you see our export in terms of volumes are contributing about 20% to our sales. In terms of revenue are contributing 23% of the sales.
Yes.
So India is a production hub for emerging markets. We're exporting to 80 plus countries, including Middle East, Latin America, Central America, Asia, Africa, etc. In fact, right from the time we set foot in India, exports has been an integral part of our strategy. You talked about foreign exchange. Yes, dollars. The export currency is dollars, and of course, we government also incentivize a lot on exports. So we get incentives of 3 to 4%, which helps us in the margin on exports. On the localization, our current localization is at 80%. Absolutely, we want to really increase the localization. If you see, the major part of imports is on the semiconductors. We believe that now there is a big plan of localizing of semiconductors as well as government is concerned. They are really encouraging more and more companies to set up units in India. So we are looking at it with interest, and as and when opportunity comes, we will look at increasing the localization content, because localization is very important, not only from a cost perspective, but also from a geopolitical point of view, because it helps us in taking care of the logistics and other issues as well. So very, very important for us to continue to work on the localization.
Got it. All right. So localization is one point that you'll work on as well. You've raised an ambitious plan for the next few years. I think 30,000 crores of capex. So how do you fund this though? Give us a near-term target. In the next 3 to 5 years, what should be the total capex plan that you're looking at? And what about funding? Because some part of the market fears you'll have to come back to the market to raise some capital.
So if you see, we have announced in our RHP that we are going to invest a total of 32,000 crores by 2032.
Yes.
32,000 crores by 2032. So it's a staggered capex. Of course, it includes the Pune plant, it includes new models, it includes everything. And we believe that we are generating enough cash and enough internal accruals to take care of these capex needs in the next 8 to 10 years, which I've said. So this is where we stand today.
Mr. Garg, just a broad sort of industry question, but very relevant to you as well. What do you think? I mean, demand and that is fine. Electrification, of course, is a theme which will continue to pick up, and we'll see at the pace of adoption, etc. But what is the for Indian automakers? Is Chinese competition a big risk as we go down that electrification path? I mean, BYD, for example. I mean, some of the Chinese players. I mean, it's not a big. There's no big level of competition here in India from them currently. But what's your sense? Because you would have a bird's eye view about, technology, level of products, and things like that. Go on, sir.
Look, if you see the history of India, and of course currently India is at the early stage of electrification. Current penetration is at 2.5%, backed by government incentives. I think electrification is only going to go up. You mentioned about Chinese OEMs or European OEMs or US OEMs or any other OEMs. Frankly, competition has always been there. What is more important is what is the company's strategy? What is the company's connect with India? How are you looking at really converting your customers, upgrading them to electric vehicles? So we believe believe the kind of game plan we have in terms of one, launching those 4 products led by Creta EV, localization, the charging infrastructure, and the strong brand connect which we have in India, we believe we are rightly poised. Of course, backed by very strong HMC parentage. It really helps us to get all kinds of technologies in India. And I'm so encouraged, actually, frankly speaking, by the yesterday's anchor response that we have received. 225 individual lines, you know, from FIIs, from sovereign funds like GIC, Norges, Fidelity, Schroders, BlackRock, and of course so many domestic institutional investors like SBI Mutual Fund, HDFC, Axis. I think that really shows that what kind of confidence, you know, everybody has in the proposition of which we have to offer.
No, and they'll hold you to it as well, Mr. Garg. But it's a good conversation, and I think it's a good way to kick off the listed journey. But I think, Surabhi, you have a question?
One last question, sir, if I could squeeze that in. And I'm just speaking, you know, out of the concerns. So it's a very well-loved brand, and that explains the anchor book as well. But just one last question, that the parent is selling a little over 17% right now, and regulatory setup and rules will require the parent to offload a little more equity to come down to this 75% minimum public shareholding requirement, right? Aside of that, I mean, will the company need to raise any further equity capital? Because none of the money that's being raised now, this massive 27,800 crores, none of that is going to the company. It's going to the parent, right? But for your funding needs to, you know, keep propelling the India story forward, will the company need to come to the market again to raise fresh equity? Because very heavy paper supply, that is one concern in the market as well. So if you could just address that.
Look, I think our record speaks for ourselves. We have a very good record of cash conversion and generating enough internal accruals. So we believe that we are adequately financed to take care of all our capex needs, in the near to midterm future. As regards the balance 7.5%, which we have to do, of course, 3 to 5 years is what the regulators require us to do, and we will definitely follow that. So, I mean, as things stand right now, we believe that we are adequately, self-sufficient to take care of our capex needs.
All right.
And to grow, continue to grow on a good path. Yes.
Well, Mr. Garg, we thank you for joining in and clarifying all those aspects with regard to dividend, royalty, how you see the market shape up. And as you said, premiumization is something that will help you in terms of growth as well in the coming years. We appreciate you joining in. Looking forward to having a chat with you, though, on the IPO listing. Until then, we'll wait by to see the response. Thanks a lot for joining in. Well, let's move on and let's focus on the markets then. You know, as we're having that conversation with Hyundai, just take a look at what happened to the markets. We're now down close to around 60 points. When we started that conversation, we were up 40, 50 points or so. There is some nervousness that's actually crept into the Asian markets on the whole, and most of them have moved to the low point of the day as we speak. Nifty is still holding about the 25,000 odd mark, but there is some selling that's crept in, and we have given up close to around 50% of yesterday's gains. Mitesh Thakkar is back with us. Hi, Mitesh. Welcome back. It's 10 a.m. So give us your call on the index first, as well as a couple of fresh picks.
Morning again, Nigel. As I said, I think, this is not a market which is breaking out, still contracting, still consolidating. I think we are kind of now tapering off from the upper end, which is first level is around 25,250, and then we have 25,350, 400 zone. So I think we still might just do this range for some time. And therefore, I think, trading with the stock specific bias is what I feel would be a better approach in this kind of market. I have one sell, and today, a lot of your metal names are breaking down. So Jindal Steel is a sell with a stop at about 990. Sorry, look for a target of around 945 here. And that apart, I have a buy on Oberoi Realty. Had a good breakout yesterday, is giving mild pullback today. So around 1975, 1970, I think, that's a good area to get in. Buy there with a stop at 1945 for targets of 2030.
Okay, all right, Mitesh, thanks very much for that. Markets off about 70 points on the day, 25,060 is where we are at. We'll take a break. We are back with commodities and what's making news. Manisha is going to be with us on the other side. Stay with us.
Welcome back. Well, we'll soon start, I think, showing you some visuals which are coming in from the India Mobile Congress 2024, which is underway in New Delhi. There you go. Industry bigwigs and the leaders of the segment. Akash Ambani, chairman of Reliance Jio Infocom, Kumar Mangalam Birla, chairman of the Aditya Birla Group, Sunil Bharti Mittal, chairman of Bharti Enterprises, all of them there. I think this was just before they went in for the inaugural session. Promises to be a big, big event where, of course, there's lots up for discussion, including the rollout of 5G and other newer technologies, and plenty of course, interactivity expected with government dignitaries and the minister himself. All right, we'll keep getting you updates from the India Mobile Congress as it gets underway. But for now, we'll shift focus to the commodity segment. We have Manisha joining in. Manisha, what do you have your eye on?
Well, I'm looking at the energy as a market because while the crude oil prices have been declining, that's exactly what you have seen across crude products as well. So starting with the energy markets itself, and the Brent prices fell 2.5% overnight. And as you can see, we are 3% down in the Asian markets right now as well. So 75 just about holding. It was just previous week that we saw 80 plus kind of levels come in for the Brent prices also. So this has been a sharp decline in last couple of sessions already. Well, reasons are that the OPEC has cut the world demand forecast for a third straight month. And this time around, the OPEC and allies feel that for 2024, the growth demand that you will see in this year would be to the tune of 1.93 million barrels per day. And next year would be lower at around 1.7 million barrels per day, 1.65 million barrels per day. So we have seen a constant decline come in for this one. Apart from that, the China crude imports have continued to decline as well. From the month of Jan to September, the overall imports have declined by 3%. And also the China markets have seen a decline also because of the lack of new stimulus measures, which the street was anticipating to come in by this weekend there. China's shifting from diesel to LNG and EV has been yet another reason that you are looking at weaker demand coming in from one of the world's largest importers and consumers as well. Well, there also are oversupply concerns in the global markets because you're looking at higher production coming from US. The spare capacity with OPEC and allies is higher than 5 million barrels per day. That continues to weigh in as well. And then there has been statement from Israel saying that as they strike Iran, it would be on Iran military and not nuclear or oil facilities. So that fear about disruption in oil facilities also seems to be going away. So that bit of a war or geopolitical premium is coming off the markets. There is weightages that we have seen come in from the dollar index as well, which is holding above 103, which is a 10-week highs. So not just crude oil prices, but if you look at the metal market today, copper, aluminum, zinc are trading on a weaker side. Gold and silver is in the negative as well. So the strength in US dollar index also seems to be weighing on. And then not just crude, if you look at natural gas, that's down by 5.8%. Heating oil fell nearly 5% in the overnight markets as well. Now going forward, it is going to be important on what the speculators also seem to be doing. At these lower levels in the previous week, we have seen net long positions being added for a fourth straight week. The shorts have been continued to be cut, which is at the lowest, by the way, now since 2016. So there is that balancing that we are seeing in the international markets also. But going forward, there's so much to watch out for. Today, you have the IEA data coming in sense of global demand and supply numbers. Tomorrow would be the crude inventories. And then as you get into the month of November, the US Fed meeting, presidential elections, and all of that would continue to impact crude and vice versa. So it's going to be a volatile month going forward for crude prices.
All right, Manisha, thank you very much for that. So oil very much in focus, but thankfully not on the boil. Now, let's talk about JSW Infrastructure. Vivek is here to tell us what's happening. Vivek, morning.
Well, good morning. Very interesting report from Nuvama today. They've initiated coverage on the stock. They have a target price of close to 390 rupees a share. In terms of earnings, they expect the revenue, EBITDA, PAT, CAGR to clock almost 19%, 16% and 15% respectively from FY24 to FY27. And they've come to the target price by giving a valuation of close to 25 times FY28 EV to EBITDA. Now, about JSW Infra, what is it that they're saying? Second largest private port company with a 25% volume CAGR that the company has seen over the last 5 years. They say that the company is poised to sustain long-term growth on the back of favorable macro tailwinds. What they're expecting is that they're expecting almost 4 times capacity growth over the next 25 years, supported by both organic as well as inorganic growth. Organic growth is coming in from the group companies itself, especially JSW Steel. Inorganic growth that the company has already done in terms of acquisitions, both from ports as well as the logistics segments. They believe the JSW group may continue to contribute almost 50 to 55% of the revenues over the long term. And they see, as far as FY28-29 is concerned, they are expecting almost 43% and 25% year-on-year growth respectively as far as EBITDA is concerned. Along with that, they see key triggers or key kicker. There's the commissioning of the Jaigarh port, the Dharampur port, the Goa port, as well as the Greenfield Jatadhar port, as well as multiple slurry pipeline projects that the company has in its kitty.
Okay, all right, got that. Thanks very much for it, Vivek. With that, let's take I think we have, in fact, before we take that break, we have Sonal joining in. Suntec Realty came out with updates as well. So let's look at those numbers. Sonal?
Well, it was a good set, and it has come in at a time when the other players have seen a YOY decline, but Suntec, on the other hand, has seen an improvement on a YOY basis in pre-sales. So pre-sales, they went up by 33%. The collections have also gone higher by 25%. However, there has been a decline here on a sequential basis. On the first half basis as well, sales are up 31% to come at 1,026 crore rupees, and collections, they've gone up by 21% to come in at 609 crore rupees. Remember, this comes in after quarters of decline that this company has been seeing. So definite improvement, and that's why the excitement on the stock today.
All right. Thanks very much, Sonal, for that. We take a break. On the other side, our special segment, it's the economy. Lata will be speaking with Shashadri Sen of MK Global, and they'll talk about the weakish kind of macro environment that we find ourselves in, and whether it'll impact second quarter earnings. By the way, some visuals coming in from the Mobile Congress in Delhi. Prime Minister Narendra Modi sort of being shown around the venue and through some of the stalls as well at the IMC 2024 event. You earlier had visuals of Akash Ambani and other dignitaries there at the event as well. So we'll, of course, get you updates from there. I think there'll be a couple of interesting speeches that we'd bring portions of to you as we go on. All right, we'll take a break. It's the economy on the other side.
this isn't an economy story as much as a corporate earnings analysis. Now, macro trends for the second quarter have been weak. IIP, core sector, both contracted in August. PMI came in at an 8-month low in the month of September. And most tellingly, GST collections in September were only 6% higher year on year against a nominal GDP growth forecast for the current year at 10 to 11%. To what extent will these macros reflect in the Q2 earnings? I have with me Seshadri Sen, the head of research and strategy from MK Global. Seshadri, good morning, and thank you very much indeed for joining us. Well, for starters, yes, we've had two biggies who have already announced numbers and a few smaller ones. But how bad is the second quarter likely to be in terms of overall Nifty earnings?
Hi, Lata. Thanks for hosting me on the show. It's good to be back to talking to you. If you look at the aggregate numbers, they aren't particularly inspiring, very frankly. There's flat top line and I think even flat bottom line. But once you dig deeper, the forecasts from our team and consensus don't look that worrying at this point in time. The stresses, I think, is focused on two sectors. One is the energy sector, where there is a high base effect. And this is the last quarter of the base effect. Cement, this is a seasonally weak quarter. And this time the seasonality has been a little more pronounced than normal. Which is why cement is dragging the overall Nifty and, from the MK coverage universe as well, down further. If you strip these two out, our coverage universe is showing about high single digit, 7% top line and 12% bottom line, which is reasonably healthy. And Nifty's, again, if you strip out these two sectors, is also showing fairly similar earnings growth. So we don't think that this will reflect majorly on the quarterly earnings. However, if this continues, then the commentary will get affected and that could be an overhang.
Let me come to the however in just a bit. What is at the moment the full year forecast? Is Q2 a one-off and full year going to be a good middle single mid-teens, high teens kind of growth in earnings?
Yes, I think for FY25, we are still looking at a low to mid-teen. High teens is unlikely, low to mid-teen earnings growth as far as the Nifty is concerned.
Okay.
And there's nothing in these Q2 numbers which disturbs that trend. Okay. And if you analyze the Nifty EPS forecasts, they've actually been rock solid over the last 6-8 months. So I don't think that there is a risk. FY26 would, however, may be a different story, especially if there are rate cuts and banks start showing some stress.
No, fair point. Let's not venture into FY26 simply because we still have a November 5th event to tide over, and that might change the world, the global jigsaw. But let's get sector specific. Which would be the sectors you would worry about in the Q2 itself?
As I said, cement is expected to show weak earnings. That's the only sector where we are seeing, as a sector, we are seeing worries, though I would argue that is known in the price. I'm not sure that it'll promote a sell-off, but as far as earnings is concerned, that's one sector which we are looking at a reasonably soft quarter. That is probably the only one. Oil and gas, obviously, energy is the other one where we are expecting year-on-year growth numbers.
Which you said that energy is actually impacted by the high base. You said that. Let me come to the stronger sectors then. Consumer is again a little troubled. The DMart numbers didn't look good. And of course, you could blame it on quick commerce, but overall the numbers were not very encouraging. As well, if you looked at, the GST numbers, GST is a consumption index. That didn't look very good in September. IIP numbers, consumer non-durables, didn't look good. So would you worry about consumer staples generally, FMCG?
No. I think there is a shift in the consumer sector in FY25, and we are going to see signs of that in the second quarter results. There is a significant slowdown in discretionary consumption. So all areas of discretionary consumption, which are not staples, which are, which show some kind of top line stress. and you will see that coming through. Those are, however, some of those companies are fairly small, but I would keep an eye out on discretionary consumption. Staples, and what is happening this year is that the momentum is shifting away from discretionary to staples. Staples, after a fairly torrid 2-3 years post-COVID, is starting to show signs of recovery. So I think, some of the positive surprises could come in the staples sector, where we will see both top line and bottom line momentum. Retailers may not be the best way to look at it, but the companies themselves could show signs of recovery.
Okay.
So we are actually, quite the opposite of what you're saying. We are quite constructive, in terms of how staples will report. However, the sectors also rallied. Okay. So,
but you're clearly super optimistic on consumer discretionaries.
No, I'm a little cautious on consumer discretionary and a little optimistic on consumer staples. I'm not super optimistic in this environment on anything because we're dealing with a fairly high base on consumption of 3 years of momentum. So one has to factor that in when one calibrates expectations.
Okay. Where is your area of comfort in terms of earnings? As in, where would you be optimistic at all?
See, I think industrials, auto ancillaries would all show reasonably strong earnings. Okay. Now, as I pointed out in my last note, that's some of that is in the price, but in terms of earning momentum, I think that is where, industrials especially would continue to show. There has been a bit of a blip in the first half, because government capex has slowed because of the elections and other factors. And maybe some of that is reflecting in the macro numbers that you just were referring to. But having said that, I think industrials will still show fairly strong earnings.
Okay.
Whether these valuations justify those earnings is a different debate, but earnings-wise, that should be one sector.
No, I'm coming to the prices in just a minute. It's just that they change so radically. But let me stick with performance. If for the full year, you said that, low to mid-teens growth is what you're fixing for the Nifty. What about the broader universe?
A broader universe is tough to make, beyond, say, Nifty, it is really tough for it to make a forecast for any index, because as you go deeper, the extent of coverage for some of these sectors are not that strong. So what we do is look at a disaggregated analysis of the top 350 companies by coverage. And there, if you look at the broken down numbers, around 65% of the companies have their earnings in the range of +10 to -5, right? Which we call as stable. So our the key conclusion from that is that broad earnings forecasts and at a disaggregated level look very stable. They've been more stable than they have for the last 2 years.
That's good news.
And that gives us comfort, because aggregate numbers, are moving parts. One large company shows a drop off, and it can get quite misleading.
Yeah, I take your point. I take your point on that. So let me come straight away to both putting price and valuations, putting earnings and valuation together, and the current price trends. Where is MK overweight?
So we are overweight on consumer discretionary, which may seem a bit odd given what I said, but there we find autos fairly constructive. We continue to like healthcare, and those are our two main overweight sectors as far as at this point in time. We are, as I said, a little cautious on the markets overall, so we aren't bullish on too many sectors at this point. Energy is the third sector that we like.
Okay, we'll leave it at that, Seshadri. It was a pleasure speaking with you. Thank you very much for preparing us for the oncoming earnings season, though of course a couple of biggies have already reported. Thank you very much for joining us in this discussion. Well, that's it on Bazaar. After a break, Chartbusters.